You're listening to AI PRISM from Seoul Economic Daily.
It's Monday, May 18. I'd like to share some thoughts about stock investors. Imagine processing $3 trillion in transactions without even touching traditional banking rails.
Right, just completely bypassing the old plumbing.
Exactly. And, I mean, that is the race happening right now across Korea's financial sector. Institutions are just scrambling to build fiat-backed won stablecoins.
They really are.
So if you're tracking structural risks and, shifts in market infrastructure, this is the digital plumbing you need to watch.
Definitely. And the race is really splitting into these distinct factions. I mean, Hana Financial Group, they actually moved first. They partnered with Dunamu to build on the Kaya chain.
So they're trying to replicate JP Morgan's Connexus model, right?
Exactly, yeah. Connexus is essentially this blockchain network for, instant 2047 cross-border payments between institutional clients. And they've already cleared that $3 trillion mark.
Wow.
But then on the other side, you've got KB Financial actively courting Toss.
And Toss is, well, it's the ultimate distribution pipe. I mean, they have 30 million users. That's roughly 58% of Korea's entire population.
It's massive.
So think about the apps you use every day. If a competitor has, slightly better blockchain tech, does it even matter if KB secures that Toss demographic?
Probably not, honestly. Yeah. Because, blockchain architecture is easily copied, but you cannot copy 30 million people who already have their bank accounts linked to an app.
Yeah, the friction is already gone.
Exactly. In institutional finance, reducing onboarding friction wins every time. It is a really crowded field, though. I mean, Kakao is weighing alliances, and Hana Financial is looking at Samsung Wallet to leverage Galaxy smartphones.
Right.
But the winning consortium will actually be decided by two swing votes. Worry Bank and IBK Industrial Bank of Korea. Whichever alliance brings those two in, they tip the scale.
Okay, so tech giants are fighting over the plumbing of money, but then you have institutions like IBK actively changing the rules of who actually gets the money. They're fundamentally rewiring micro risk for small and medium-sized enterprises.
Yeah, and you have to look at the sheer scale of their exposure. IBK holds an SME loan balance of 264.2 trillion won.
Which is approximately $189 billion.
Right. So to manage that, they're shifting away from strictly history-dependent credit scoring. They're moving toward behavior-based pricing.
So lowering rates for borrowers who diligently renew without delinquency, that kind of thing?
Exactly. And tiering rates based on the loan amount itself.
Wait, hold on, though. I'm looking at their delinquency rate right now, and it just hit 0.95%. If defaults are rising across the board, why on earth are they relaxing their grip on small loans? I mean, that feels like stepping on the gas heading into a blind curve.
Well, that assumes the old metric is the brake pedal, right? Straight credit scoring is like driving by, looking in the rearview mirror. IBK's new behavioral scoring is more like using real-time GPS traffic data.
You have to remember, IBK is a state-owned policy bank. They're driven by a mandate for inclusive finance.
Right, so they have a different primary goal.
Yeah, but it's grounded in a specific data hypothesis, too. For very small loan balances, the difference in default rates across traditional credit scores becomes statistically insignificant.
Oh, really?
Yeah, they're betting that actual real-time repayment behavior is just a much safer metric than an older, rigid credit score.
Okay, so if you contrast IBK relaxing risk parameters for small borrowers with, what's happening at the absolute top of the market, it's wild. Institutions are ruthlessly tightening risk governance for massive private equity buyouts. Look at the Homeplus receivership standoff.
Yeah, Homeplus needs a DIP loan, a debtor-in-possession loan. It's basically emergency funding to keep a bankrupt company operating while it restructures.
Right.
But Meritz Financial is flat-out refusing to extend those funds without a joint guarantee from MBK partners.
And they're the private equity firm that acquired Homeplus.
Exactly. And the pressure to tighten up, it isn't just coming from the top. You have junior bondholders holding short-term commercial paper, known as J-Donche. These are the subordinated creditors, the investors at the back of the line.
Right, the ones who get wiped out first if the company goes under.
Exactly. And they are literally threatening Meritz with criminal breach of fiduciary duty lawsuits if they extend that DIP funding without prioritizing them. I mean, does Meritz's hardline stance signal a new era for foreign private equity buyout financing in Korea?
It really does. It proves even large Korean financial institutions are, tightening their governance around distressed lending. Meritz is making it clear they need MBK's performance guarantee just to justify the loan to their own shareholders.
So the days of easy distressed financing without rock-solid protections are officially over.
Yeah, it's a massive shift in how capital is deployed and protected. So as you process these structural shifts, from stablecoin distribution to distressed lending governance, keep your eyes on the pending Digital Asset Act. Its passage is the legislative trigger that sets these new institutional infrastructures into motion, which really leaves you to wonder, if banks are successfully pricing risk based on our daily behaviors, how long until every financial transaction you make is judged in real time?
That's today's AI PRISM, stock investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a Juan Ifra award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.